Tom Halverson, thank you for being with us again for another check-in on the state of the economy. It's been quite a few months since we've gotten you here in the studio because you've been traveling so much, but we're delighted to have you with us today. We have two topics we want to focus on. One, the state of the banking sector here in the United States, and then secondly, the issue of deglobalization in the world economy, which is a big subject that's in the news headlines a great deal right now.
Very good. I'm glad to be home and glad to be here to have another conversation.
Tom, let's start with the financial sector and the disruption that we've seen there over the last couple of months. There have been a number of bank failures since March. Things seem like they've settled down as of today, but what do you see? Is this something that's in the rearview mirror now, or is there more trouble yet ahead?
I don't think that we can safely say that it's all in the rearview mirror, right? The market is an efficient place. It's been sifting and sorting regional and community banks to find the ones that are most exposed and have the most risk and the most danger. A lot of those have been identified. Several prominent ones have failed over the succeeding period. Those that are most weak and vulnerable find themselves in quite a difficult spot, and some of them are proving hard to resolve. That process is not entirely finished, so I would anticipate that there may still be some issues that manifest in the community banking and regional banking sector, though hopefully with less size, magnitude, and impact and implications than the ones that happened earlier in March.
One of the really remarkable aspects of this most recent crisis was the rapidity of how quickly deposits left some of these institutions. At Silicon Valley Bank, I think it was something like $40 billion of deposits fled in a single morning or a single day. Yes. That's just astonishing, and I think it's connected to mobile phones, mobile banking, that whole new dynamic. Talk about that a little bit, and what implications does it have for banks in terms of risk management going forward?
Business in general, banking in particular, is always trying and struggling to catch up with the dynamically changing technologies, right? That's not just in business, it's just in life, right? And the experience at Silicon Valley Bank demonstrated the fact that we thought we understood all the impact and implications of digitization of commerce in general and banking in particular, but we obviously hadn't, right? Because we've never had a bank run occur of a magnitude in an environment where everybody can move their money on an app on their phone. Right? There's never been a situation where $42 billion moved out of a bank in real time in the morning because everybody pulled their deposits out without going to a branch, doing it by phone. What that means from a risk management perspective is that's a really hard risk to hedge, right? It means that the intrinsic vulnerabilities of a banking platform, which is very confidence sensitive, means that something that used to take days or weeks to manifest can now happen in a single day.
One of the issues that most banks face today, even ones that are healthy, is the issue of unrealized losses on their balance sheets. And we have a chart that shows this. This is how these losses have evolved and grown over the last year as interest rates have risen. For the lay viewer who's not a banker, just explain what this means, number one, what's happening here. And then secondly, and more importantly, what is the level of overhang that this problem is going to have for lenders and then also for borrowers who need debt capital?
The value of fixed income securities is very sensitive to interest rates, right? And so when you own a very large pile of fixed income securities and interest rates rise dramatically as they have over the last 12 months, those securities become a lot less valuable on a mark-to-market basis, right? So whatever they were worth a year ago, they're worth a lot less today if you have to sell them. If you have to sell them, they become realized losses, and they are a real economic, negative number in your income statement. But most banks and insurance companies and the like, they don't hold these things with an intent to trade them or sell them on any given day. They hold them as a liquidity portfolio, and they intend to hold them to maturity, in which case they have a regulatory regime that allows them to account for those as unrealized losses that don't have an impact on their P&L and their income statement, and they're able to ride that out over the course of time as those values pull back to par. It does, however, have a contractionary effect, because the reality is that your equity capital is shrunk. If you actually had to go out and raise money or sell some of those securities to raise liquidity, it would actually cost you a lot of money. So it has a contractionary monetary impact because it diminishes people's risk-bearing capacity and risk appetite.
And depositor flight can create that very circumstance.
That is correct.
Last question on this topic, which is, if you could just talk about the financial position of CoBank and the broader farm credit system, since we are lenders. Where is the system and farm credit and CoBank relative to their ability to ride out this turbulent period and continue serving borrowers in rural America?
Well, I could talk all day about the many virtues and benefits of the farm credit system and the cooperative business model. We only had time to hit the highlight, and the highlight, of course, is we're a co-op, right? And we do not have publicly traded stock, and we do not have depositors. And therefore, if you wanted to have a bank run on the farm credit system, or CoBank in particular, you can't do it. No one can come into CoBank and ask for their deposits back, right? Therefore, we are in robust, good health. We have ready access to the debt capital markets, which is our form of financing. We don't take deposits. We raise our money across the maturity spectrum in the international debt capital markets, and that access is very robust across the curve, very liquid, very dynamic, very attractively priced.
So let's pivot to the second issue that we want to cover with you today, which is the issue of deglobalization. You've been talking about this issue at our customer meetings over the last couple of months. It's been in the news a lot. For people who haven't seen your presentation, just talk about why the issue of deglobalization has been in the news so much over the last year.
There are a lot of reasons. The most obvious one that anyone can see is that the relationship between the United States and China is getting worse at an accelerating rate. That takes many forms, including the fact that we have slapped lots and lots of tariffs on each other's products. The worldwide tariff reduction process that went on for 30, 40 years before the last few years has gone into reverse. And the great powers are starting to pull apart, at least China and Russia on the one hand, and the United States and its Western allies on the other. And so it's obvious to everyone that that process of deglobalization appears to be going in reverse.
We'll bring up a chart here that shows a couple of things. One is the growth of world trade over the last several decades, and then also concurrently the growth in global income per capita. Both have risen dramatically since about 1990, which is the period when globalization really took off and began. Talk about what these charts show and what is the connection between these two numbers here and why they're connected.
It's important. I think there's a pretty broad consensus that growth in economic activity, growth in wealth is better than the reverse, right? There's also a broad and deep consensus among economists that openness to trade and liberalization, small L liberalization, that creates multilateral and bilateral mutually beneficial outcomes through trade, creates faster and larger amounts of economic activity and growth, which manifests itself in GDP growth and per capita GDP growth and so forth. And that the reverse is also true. To the extent that you close your economy down, you put on tariffs, which are taxes on economic activity, you impoverish yourself and you impoverish your trading partners. So you would expect to see this process of high positive correlation between openness to trade, liberalization of trade, higher levels of and growth in international trade corresponding with a growth in GDP.
You talked earlier about deterioration in U.S.-China relations. Another big thing that's happened in the last year is the war in Ukraine. What's the connection to the Russia-Ukraine war and the deglobalization issue?
There are many connections. Okay, what I would tell you is that the government of China has its own agenda to differentiate itself from the United States and our closest allies around the world. The Russian government has another agenda, which is much more aggressive and violent and confrontational in terms of trying to provide an alternative model to open, liberalized, democratic, market-oriented economies. And so the fact of the matter is we are entering a period of potential great power conflict, which is more dangerous and difficult to manage than we've been in for any time in the last 30 plus years. And that creates additional reasons and causes for the process of deglobalization to start to go into reverse, or at least to start to fragment, which is what we're seeing happen in the world, where us and our closest friends get closer together and want to do more together, whether it be economically or diplomatically or militarily, and the Chinese and their friends and allies, and the Russians and their friends and allies, though both of them have very few friends and allies based on the policies that they are pursuing, take a different tact. And that deteriorates the desirability for other people to invest in China. Certainly, they don't want to invest in Russia, and that is turning that process of globalization into a reversing process.
What are the implications for the CoBank borrower base, which includes tons of agricultural companies, agribusiness companies, and a lot of companies that deal in the world of energy? What happens going forward to in the world, and then what are the implications for all these incredibly important rural sectors that we finance?
Well, we finance a small, finite number of sectors that are all essential and vital for businesses and individuals in rural America. Some of them are quite impervious to what's going on in the world, but some of them are very, very exposed to commodity prices, energy markets, and they operate in businesses that are effectively highly liquid world markets: corn, soybeans, energy, etc. And so this development broadly on what's going on in the world has very tangible and direct impacts on hundreds of our customers. And it creates a very different context in which they have to make long-term investment decisions about their business.
What do you see, admitting that this is a hard question to answer, but what do you foresee going forward? What is the world going to look like in terms of the level of integration and openness 5 years from now? What do you expect?
I expect that the level of openness and integration among the United States and its closest partners, i.e. its NATO partners and Japan and so forth, to be at least as strong and probably meaningfully stronger over the next 5 years. Unfortunately, the flip side of that coin is that the fragmentation and the tensions and disaggregation that's occurring, particularly with Russia and China, unfortunately, I consider that to be likely to continue to intensify and accelerate. There's no hope of trying to reverse the dynamic in the case of Russia. There's just not a good ending here or a good outcome. In the case of China, it's very hard for me to foresee a meaningful change in the attitudes or policies of the ruling party in China. We're certainly not going to change our view of what we think about that, and therefore the complexity and the difficulty and the dampening pressure on globalization and integration in our relationships with those two countries, I think is going to get worse. And I think it's going to become increasingly hard, particularly with China, for us to safely manage that relationship, which, as I often say to people, is the most important and consequential bilateral relationship on Earth without question.